Welcome to the exclusive channel. Today we are going to talk about 6 interesting things about the history of the stock market. The stock market is a trading phenomenon that appeared in civilization as early as ancient Rome and is still with us today. It has become one of the most important and influential financial instruments in the world. Throughout its history, the stock exchange has gone through different periods. Sometimes it flourished and developed, positively affecting the economy of many countries, and there were also times when it was banned by religious radicals for centuries. Here are 6 interesting facts from the history of the stock exchange. Fact number 1. First stock exchange in the Forum in Rome. We find the first phenomenon of venture investing as early as ancient Rome in the 2nd century BC. Rome was one of the most advanced civilizations that left behind a lot of value for today's societies. In Rome there were the so-called Publicani, state representatives, responsible for collecting and assessing taxes. Income tax at that time was 1% of income, and in the case of war 5%. What a beautiful time! Publicani over time, in addition to collecting taxes, began to collect money for various public projects, roads or buildings. Shares in these projects were created as documents guaranteed by the government with a rate of return. People who had money often preferred to invest it in just such projects rather than put it in a pile. In addition, Rome also had a market called the Forum. It was a place in the center of Rome where people met to discuss new projects and offer shares in those projects. Trading between people in these shares also took place there. This was the first recorded example in history of a stock exchange that also lived to see regulation in Rome. It can be considered that this exchange also influenced the development of Rome's economy and expansion. Fact number 2. 1,000 years of the Dark Ages. Unfortunately, Rome fell, was conquered by barbarians, and religion, often very radical, also began to rule in Europe for a long time. There came a time in Europe called the Dark Ages, and later the Radical Middle Ages. Rome existed from its historic founding in 752 BC until the 27th year of that era as a republic, then as an empire until 476 AD. Religious doctrine held that making money with money is a sin. In the 13th century, St. Thomas Aquinas wrote that it is also a sin to sell more expensively or buy more cheaply than something is worth. This has been the message of religion for centuries, and the stock exchange was banned. These thoughts were also developed by St. Augustine, who said that a human activity, whose goal is profit, is an immoral activity that arouses in people an endless desire to earn money. Also that lending money to others to receive a profit, in the form of a percentage of the amount lent, is a cursed activity. Augustine even called it appetitus diviritum infinitus. For centuries there was a deep moral conflict of the Church that blocked any development of financial exchanges. The same was true in the Islamic world, which considered stock exchanges condemned. Fact number 3. 14th century Venice. Only later, more than 1,000 years after the fall of Rome, during the Renaissance, when humanity began to be reborn again, prosperity increased. Athenian and Roman ideals were revived in Europe. The need for development, the need for capital, and the need for credit begin to arise again. In any developing society, these forces eventually arise. Rome provided the template for the creation of new exchanges. In 14th century Venice, which was becoming a prosperous republic, with developed trade with the entire Mediterranean. To minimize the risk of expeditions and speed up the process of raising funds for sea expeditions, the Venetians created a system of participation in commercial ventures. These merchants created something like companies. They called them commenda in Italian. They consisted of raising capital for an expedition, using documents called shares that guaranteed a percentage of profit from this expeditions. Later, these documents also began to be traded among themselves in a specially dedicated building. It was called Fondaco dei Tedeschi and was located in Venice. Germanic traders met there with Mediterraneans. It is said to have been one of the first examples of a dedicated securities exchange in the world. The Venetian government was quick to recognize the importance of this event to the country's economy and created regulations to ensure that this trading took place legally and transparently. The Venice Stock Exchange played a significant role in the development of Venice and paved the way for the creation of later exchanges that became engines for the global economy. Fact number 4. Exchange in Belgian Antwerp. In 1460, the Bourse of Antwerp was established, and it quickly became one of Europe's most important financial centers. The stock exchange began with merchants, traders who traded goods with each other, and later it evolved to trading shares of merchant corporations. Throughout the 16th and 17th centuries, Antwerp was one of the wealthiest cities in Europe. The Antwerp Stock Exchange played an important role in international trade. It was also the main place where the Spanish and Portuguese governments sold their bonds, which were spent to finance overseas exploration and colonization. However, Antwerp's fortune began to decline due to political instability, wars, and competition from other financial centers. Fact number 5. Amsterdam Stock Exchange. The most important event in the history of the exchange as we know it today is considered to be the establishment of the Amsterdam Stock Exchange in 1602. This exchange started the so-called Golden Age of the Netherlands. In Amsterdam, the trade over the sea started to flourish. The Dutch created Dutch East India Company. Its purpose was to trade with Asia, mainly Indonesia. It was the largest trade company in history and has had a significant impact on the shape of economics around the world to this day. The company grew to gigantic proportions and was an excellent investment for all who bought its shares. The company had a monopoly on trading spices such as nutmeg, cloves, and pepper. The company employed 50,000 people and had about 1,700 large shareholders owning 2,000 shares each. These were mainly wealthy traders and merchants who saw the potential of the venture and invested in it. The Amsterdam Stock Exchange was created mainly to trade shares of the Dutch East India Company. It is very difficult to estimate in today's money what the revenues of this company were, but some sources say it was about $7.5 billion a year in today's money. Despite its economic power, the Dutch East India Company was eventually dissolved in 1799. Almost 100 years later, due to poor management and emerging competition in Europe. And the Amsterdam Stock Exchange was incorporated into the Euronext exchange, an exchange that operates in Brussels, Dublin, Lisbon, Oslo, and Paris. Today, this exchange focuses mainly on technology companies and is Europe's largest exchange with a capitalization of $5.9 trillion in 2023. Fact number 6. Development of exchanges in the world. The Amsterdam Exchange paved the way for the establishment of other stock exchanges. Thus, in 1801, the London Stock Exchange was established. At the end of 1792, 24 brokers signed the Buttonwood Agreement on the Lower Manhattan to establish the American Exchange. This is considered the birth of the American Exchange. At first, the exchange offered only buying for brokers from the agreement. In 1878, the Tokyo Stock Exchange in Japan was established. This exchange played a significant role in Japan's economy until 1912. It influenced the country's rapid modernization and industrialization. In 1971, NASDAQ was established in the States. It was the first electronic exchange in the world. In the beginning, it was just about displaying stock prices on teleprompters. But later the NASDAQ exchange became electronic only. It transformed itself into electronic-only trading. In 1983, the London Stock Exchange implemented the automated bookkeeping system for stock trading. In 1990, ECN's electronic communication network showed a new electronic system alternative to the current one, where electronic systems collated buy and sell orders for shares. 1998, a fully electronic system was implemented by the Tokyo Stock Exchange. In 2000, Many stock exchanges converted to electronic systems as a result of technological advances. In this way, stock exchanges have globalized. Today, the electronic form of trading on exchanges has become dominant. Many exchanges have also started using HFT, high-frequency trading. This is an algorithmic trading strategy using computer programs. High-frequency trading today is stirring up a lot of controversy. It creates new questions about the impact of these algorithms on the world economy and raises doubts about the integrity of the exchange. In 2010, the Dow Jones stock market experienced the so-called flash crash when the value of the stock market fell by 1,000 points in one day. This raised concerns about HFT. Some believe that HFT is dangerous, and others believe that HFT increases the efficiency of stock exchanges and trading on them by increasing the speed of money flow. That's all for today about the history of the stock exchange, one of the most interesting economic phenomena. Stock exchanges shape today's economy and are most advanced mechanisms on the market. Do you think that stock exchanges are good for the market, and what is your opinion on high-frequency trading? Please like and subscribe if you enjoyed this material, and see you in other videos.